Walgreens is the latest big name retailer to acknowledge serious strains in the US economy by cutting prices. The company says its customers are struggling to buy everyday essentials. Therefore, it's offering more promotions as well as some permanent price drops. It's exactly what we see in the just released May CPI report. No sticky inflation here, just worsening economics. And Walgreens joins a large and growing list of businesses themselves struggling in this economic climate, one that is increasingly disinflationary, and that's not a good thing. Customers can't afford to buy essentials, so businesses have to adjust prices, and when they do, they start adjusting their own costs too. We've already seen that as the unemployment rate has made a noticeable move higher. Today, we get even more confirmation, as I said, in the May CPI. For the first time in 3 years, the rest of consumer prices, apart from food, energy, and shelter, outright declined. That's the part with Target, with Walmart, McDonald's, and now Walgreens. The government data substantiates everything else we're getting, apart from the payroll number, that is. See, consumer prices were never sticky. They were just influenced again in the short run, this time by one-time insurance and gasoline costs. Those didn't lead to more inflation. If anything, they're partly responsible for the overall and accelerating weakness we're now getting in all forms. With that weakness, of course, bond yields are sliding all over again, at least before the FOMC meeting, which is happening after I record this video. As it stands in the Treasury market, the 10-year Treasury is down to 427 again. What payroll report, right? It's as if the payroll sell-off never happened. Instead, rates want to go lower. The 2-year's down to 468, showing again that payrolls are a distant memory because those have no correlation with consumer prices or the rest of the economy for that matter. And we see this all the time, the historical pattern that I've referred to ever since the bond rally last year. Rates go down in a historic fashion, and then the bond market goes sideways to slightly higher for a multi-month period. Now we're closing in on 6 months. That's exactly what's happening. And as the bond market goes sideways through this pause phase, it is looking for entry points for the next leg in the rally. And that's what the market has been doing over the last month. Searching for that moment when Jay Powell and the Federal Reserve will get the hell out of the way. Once consumer prices prove sufficiently to policymakers that they're disinflationary because the economy's weak, that weak economy fundamentals get priced more and more back into the Treasury market. And speaking of fundamentals, we're going to be having a webinar on June 28th at 6:30 p.m. Eastern Time, where we're going to talk all about interest rates and fundamentals, where the fundamentals are going to be over the next 12 months, because we've got central banks that are pivoting. We've got all sorts of macro factors, including disinflation that we're just getting today, what we're thinking as far as the monetary plumbing, why fundamentals drive rates, not the mainstream nonsense about supply and demand. It's all the usual stuff that I write about every day here at Eurodollar University's Deep Dive Analysis. And you can sign up for it. There's a link in our description below the video. And I'll let you know more about our Eurodollar University anniversary sale that's going to be coming along with it. I hope to see you there. Again, link in the description. The fundamentals of interest rates, weak economy, low growth and low inflation expectations, rates going down, companies saying their customers can't buy everyday essentials. Again, as I said in the introduction, the latest is Walgreens. Walgreens announced at the end of last month, just a couple weeks ago, that they were introducing more opportunities for consumers to save throughout the season and beyond. The company also plans to introduce a series of promotional campaigns, including the return of Walgreens' popular My W Days in mid-July. The statement continues, Walgreens understands our customers are under financial strain and struggle to purchase everyday essentials. We continue to be committed to our customers by lowering prices on over 1,000 additional items, something that we've been doing since October of 2023. And while they may have been doing this since October 2023, they clearly haven't been doing enough of it. In fact, they have to continue to do more. And it's not just because their competitors are cutting prices, because, as the statement acknowledged, the economic climate is nothing like the payroll report. It's increasingly proving to be like the household survey, rising unemployment, incomes that aren't keeping up with prices that are surging on a temporary basis for one-off, and I will say the term, transitory factors. We'll get to the CPI numbers in just a moment. In one recent article, it noted Amazon, Walmart, Target, and others are all duking it out with discount deals. And with each markdown, they hope their bargain will be the one to win over inflation-weary consumers. It's not inflation. While some retailers say they're cutting prices to give shoppers deals, the efforts clearly align with the company's needs to offset declining sales as inflation, it's not inflation, remains elevated because it's not going to stay elevated. In recent weeks, a slew of quarterly earnings reports and other company announcements have underscored the extent to which customers are chasing deals and how quickly retailers are taking action. We talked about Kohl's just recently. Remember what Kohl's said? They said when we stopped doing clearance sales, our customers disappeared. They stopped shopping in our stores. Price sensitivity is the fancy way, the kind way of putting a weak economic environment. Back to the article. Retailers respond when consumer sentiment seems to hit a tipping point, according to Jerry Sheldon, Vice President of Technology at the market research firm IHL Group. The entire supply, demand, and cost sensitivity tipping point is quite fragile, it seems, and no retailer wants to be positioned as a price outlier from the self-defined peer group. And that's, again, a kind way of putting it. It's not sentiment that's tipped, it's the ability of consumers to spend on everyday items, let alone discretionary items, which we've continued to hear about from other retailers and other businesses that consumers don't have the funds to spend on those. What we have here is continued confirmation of a couple things. One of those being that this is indeed the downside of the supply shock. The cycle continues to move. It didn't stop. It didn't go away. There was no soft landing. There are twists and turns, and nothing ever goes in a straight line. And this cycle, which is still a cycle, has been an unusually long one. So there are even more twists and turns along the way, including where it comes to consumer prices. When everybody said that consumer prices were being sticky, they've said the same thing several times over the last couple of years because it has taken a couple years to get to this point. This point where we're finally seeing more clear signs of the downside of the cycle as well as what that means for the next stage. And it looks a lot more like recession than not. But the other thing we have to acknowledge is that this was never inflation. This was not genuine inflation as inflation actually is. Inflation is the overabundance of money and credit flowing through the economy. What we had instead was an imbalance between supply and demand that was forced on it by the unique and huge circumstances of the pandemic period. Demand started to come back, in large part supported by government efforts, far more than supply was able to supply. The only way to reconcile those imbalances is with large price increases or price changes. And that's exactly what happened. But the downside of that supply shock is never symmetric. It goes up really quickly, and then it takes years for all of those distortions, and they are distortions, to filter their way through the economy. It's almost as if we're draining the economy slowly of all of those excessive distortions, and it takes time to filter all of those out. And the reason why it takes time, and the reason why it's not inflation, the reason why it's a supply shock and distortions is because we're essentially creating unproductive redistribution throughout the system. We're taking from some of the most productive parts of the economy and redistributing to more of the unproductive parts of the economy in increasingly harmful ways because of those really non-economic factors associated with the supply shock. I'll give you a perfect example. One of the biggest price increases was, of course, energy. Energy companies were one of the biggest sets of beneficiaries to the supply shock, to price changes. And what did oil companies and energy companies do with their windfall? They bought back shares. They paid their enormous dividends, but in the last couple of years, especially 2022 and 2023, they bought back billions upon billions of shares. As Bloomberg put it, oil super majors returned more cash to shareholders than ever before last year, that's 2023, as management teams reined in spending on new projects to free up cash for dividends and buybacks. And there may be more to come, and that's exactly my point. ExxonMobil, Chevron, Shell, Total Energies, BP spent a combined $113.8 billion on 2023 dividends and share repurchases despite a slump in crude prices. Consumers paid more to oil companies, and this is not to pick on oil companies, they just did what they always do. The oil companies got a huge windfall, and then rather than reinvest in their productive capacities, they simply returned all those funds to shareholders. They redistributed to shareholders who did God knows what with it. Again, this is not a criticism of that process, but it was money that was redirected in a more inefficient fashion, when what the economy really needs to continue to grow is for oil companies or other beneficiaries of that windfall, like shippers and logistics, like companies like Maersk, if they would have invested in increasing productive capacities, because that would have put more people to work. It would have been more productive investments. But that was never going to happen, because the nature of the supply shock was to move more funds and more resources in unproductive ways. And eventually, over time, that comes back to bite you. As the excess slowly drains away from the real economy, it leaves the fundamental situation more and more exposed. That looks nothing like what everyone was assuming was going on in 2021 and the first half of 2022. So we see this in the labor market numbers too. I've talked about these recently, not just the recent payroll reports, but just the overall baseline that shows that the economy never recovered. It never recovered. According to the household survey, we're 8 million employees short what would have been a full recovery, returning to the pre-pandemic baseline, the 2010s baseline. We're 9 million full-time jobs short of recovery, and even by the establishment survey, we're 4 million payrolls short of returning to that 2010s baseline. So the economy never recovered, because so much of the inflation, so many of the price changes and those windfalls that came with them went into places that were not recycled back in the most productive fashion by putting people to work. By redistributing so much in unproductive fashion, channeling it through the stock market, returning to shareholders, that's just, even if some of that money ends up in the real economy again, it's the most inefficient way to run an economic system. It's more inefficient than what would have happened had we never had the supply shock in the first place. So that distortion ends up leaving an economy that never recovers. We don't have enough jobs, we don't have enough income, and inevitably we have to have a reconciliation, the downside to the cycle. But as I said, it happens on its own pace and its own schedule. So the May CPI report comes out, and there's no stickiness anywhere in this one. First of all, as we expected, gasoline prices went lower. There's a seasonal pattern in gasoline. And in May, gasoline, combined with weak demand as well as getting past that seasonal point, wholesale gasoline prices were lower. That was reflected in the CPI. The overall headline of the CPI was just barely positive, 0.01% month over month. And that's the lowest monthly increase since July of 2022. The year-over-year rate was 3.25% year-over-year, a little bit less than last month in April, but that's still too high, and it's still too high because of recent months. Motor fuels, I said, gasoline prices in the CPI, those were down 3.64% month over month, and they had increased by about 8% in the 3 months before then. The core CPI, which is something, of course, everybody watches, the core rate was just 0.16% month over month, which is the lowest monthly increase in the core index since August of 2021. So it's not just gasoline that's going down, that's disinflationary. The year-over-year rate was 3.41%. That's still too high, but again, more about recent months. And even so, that's the lowest annual rate since April of 2021. And that's despite another unhealthy contribution and likely artificial contribution from shelter prices. Owner's equivalent rent was steady around 0.43% month over month, which is where it's been all year. Has no bearing on the real economy. It's just the imputation and everything else. When you take away shelter rent prices from, say, the services part of the consumer price bucket, those were flat, just 0.02% month over month, after being weak or increasing at a slow rate in April after the big gains the 3 months before, as insurance costs primarily start to come back down to earth. So you have big gains in services, less rent, January, February, March, a big slowdown in April, and basically flat services prices in May. But when you look at the consumer price bucket outside of food, energy, and shelter, as I mentioned in the introduction, that part actually declined. It was just a fractional decline, but it was the first negative number in all of the rest of the consumer prices combined since January of 2021. And that's the part which is validating all the moves and announcements Walgreens and Walmart and Target and everything else that we're seeing in the consumer economy. Anecdotes marrying up with actual economic data. And according to this part of the CPI, it's rising at a 1.87% year over year rate. And again, that's influenced a lot by the most recent months. So we're not seeing sticky consumer prices. We saw transitory increases in insurance as well as gasoline that only added more strain to the consumer economy, which eventually leads to the disinflation that we're seeing, as well as, more importantly, all the recession signals that have popped up lately, outside the payroll report, of course. So, I mean, it's understandable why people were freaking out at the early part of this year, a couple months ago, over sticky consumer prices. Because if you don't understand where consumer prices are coming from, and the Federal Reserve and economics does an incredibly poor job of educating the public about those things because it doesn't really know either, it's understandable why people would look at the CPI and just react to the latest one as it comes in. When all along you could see, looking through the details, looking through the rest of the economy, listening to these companies, the economy was weak. It was not in any type of shape that would let you believe that it was inflationary, that it was resurgent, or anything of the sort. We continue to see more and more evidence, and more consistent evidence, even during these sticky CPI episodes, that showed the economy was in the downslope of the supply shock. Everything has been consistently pointing in this direction. It's just now becoming increasingly clear. And as I said a couple months ago during one of those sticky CPI reports, I said, watch, look what happens when gasoline prices eventually drop, and the CPI does too. All the stickiness talk will just disappear because it was never really sticky to begin with. People are simply reacting to what already happened rather than understanding what's actually coming toward us. What's coming toward us is more than just Walgreens. What comes next is even more disinflation around the economy, and that's not a good thing. Consumers are struggling to buy their everyday essentials. They can't afford discretionary items. Businesses see less revenue, not just in retail, but also in production and goods economy, as well as services. And as they struggle with revenue, they have to make decisions about their own costs. Do they cut back even more on hours? Do they start letting go even more workers? Does the unemployment rate rise much farther? We get into the vicious cycle that we all associate with recession. We've already been halfway there to this point so far, maybe even 3/4 after the last household survey data. So the question is, are we now seeing these signs that suggest we're about to complete the downside of the cycle? While everyone was focused on the last payroll report and how inflation-y it seemed to be, the rest of the employment data was highly recessionary. I talked about that in the video linked below. As always, thank you very much for joining me. Check out our webinar, June 28th, link in the description. Thank you very much to Eurodollar University members and subscribers. And until next time, take care.